but here we are. So I hope you are all able to see the screen, see the document. So what we have today. I see a lot of new names today. So maybe if you want to take 30 seconds and introduce yourself, what brings you here, what are you interested in, that will also help me to make sure I have the content that is really useful for what you guys are looking for. So I see your name, Akshay. I believe this is your first time.
Hi, yeah, this is my first time. I got to know about you from that MMNA group.
Yeah. Okay.
Yeah, and interested to listen. Yeah, more about some options for retail investors.
So are you mostly on the long-term stock holder, or have you already been investing, or you're just starting on your journey?
No, yeah, I have invested for last 2 to 3 years.
Okay.
Yeah, that's it.
Okay. Are you also into options?
No,
Okay.
not yet.
That's fine. See another name, Monish. Sorry, I'm just going by from top down on the participant list. Asif he's been there for years. I see Narinder.
Yeah, it's Narinder.
Here.
Yes.
What brings you here, and what's things that interest you?
I'm looking more to learn more about the investment, and I mean, I'm not a finance person, so wanted to learn more basics about how to look around and do different investments and those things.
Okay, we have at least we have two things in common. One is I'm also not a finance person, and also I'm always hungry for looking for more, always learning around the investments and all that stuff. So
Yeah,
you're not
makes
alone
sense.
here. I think
Okay, great.
majority of the folks here are not financial professionals.
Yeah, that's one message I left other day for the Bank of America with 6.5%.
Okay.
So I thought
Yeah.
it's good to know that now.
Okay. All right. I see another name, Anand. I don't know if the Anand that used to join is a new person. Hey, Anand. Hello. Is it your first time, Anand? Okay. Let's move on. Arun. Arun, is this your first time?
Yes.
Okay. What brings you here? Number two is, have you already been investing? What's your specific interest when it comes to investment?
I have been investing through financial advisors and firms, but overall, I feel like I'm getting a little bit disconnected from the market, and I want to kind of understand a little bit more. So more from a learning education before I take actions.
Okay. Perfect. Okay. For whatever reason, I think the names keep moving up and down. I guess it's based on whose microphone is muted or not. So I see another name, Puneet.
Yeah, hi, Vivek. First time today.
Okay.
Again, interested in this subject. I've been investing for some time. I consider myself as a long-term investor, but I'd like to learn about options also.
All right. And I think, I guess that's all. All right, guys. So let's get going. There are a few more regulars who will join. Whenever. I mean, this is the open forum. Feel free to join when you can. No obligations. Feel free to drop off if you don't feel that the content is right. But do give me a feedback if you think, hey, this is, if I'm going too fast, or you want me to cover and focus on any specific topic. Again, I'm not a financial advisor. I'm not from a financial community. Because a lot of people are joining for the first time. I spent like 22 years and going in the tech industry. Came to US almost 14 years ago and was completely like a deer in headlights trying to figure out, hey, how does this investment works here? Because the process is different, the way it happens in India, a little bit on the IPO side and all that. So started my life here from a financial perspective, started my life very recently in US, not decades, but 10 years. And over the last 7 years, became more interested in derivatives, options, and all that stuff. So started going more deeper and deeper into more from managing the risk on the portfolio, right? But again, my thesis is still buy good companies, hold it forever, possibly, minimum 5 to 10 years, and then reduce the cost basis so that becomes easier to hold. So that's my philosophy. Okay. What you will not hear from me, or if I'm saying something, just remind me that is how can I make 200% gain in a trade, right? Or hey, how can I find some penny stock which can become 10x in a month, right? Those are the things that I don't focus on. I'm not saying right or wrong. There are different kind of investors. There are different type of investors, and I am not that kind of investor. So if you're looking for some hot tips or which stocks could move next week, sorry, I don't focus on that. But I'll be happy to listen if you have an idea around that. Okay. I see a question. Anand says able to unmute. Unable to unmute yourself. Let me see. Anand, you can try it now. Okay. Okay, Ramesh, can you ask which chapter? Okay, we can probably discuss that later. All right, so let's get into today's session. And as always, if you have any question, maybe raise your hand on Zoom, and then after that, unmute yourself, ask question or put it in the chat. Okay. So today, the two main topics that I have on my agenda. One is, of course, we are into earnings season now, and there are a lot of companies that have started reporting. I mean, the earnings season started 2 weeks ago, started with the financials, but this week there are few companies that we've been tracking for last 3 years, ever since it's almost 3.5 years since I've been doing this. Today is 192 sessions. So we're gonna review the earnings for Netflix, Tesla, TSMC, and ASML. That's one topic I want to cover. The other is a continuation of our previous session, is around the investing, right? So in our previous session, we looked at how to get started in investing, right? If you're new to investing, just came to US and you want to get started in investing. So I covered that topic up till the level of, hey, being a passive investor, right? ETFs, etc. And I mentioned in the next topic is when I'll cover, if you want to invest in individual stock, what's the process, right? So I'm going to walk you through the process that I would like to follow. I'm not saying I've followed it for every stock, but I try to do it based on availability of time, is to follow it for every stock that I want to own in my portfolio. And that also gives me an opportunity to bring a stock up for discussion. So we'll basically take a live case of a company that is listed in US market and use that as an example of, hey, how to analyze, or a way to analyze a stock and see if it is really worth investing in that or not. Okay. So those are the two main topics. Probably spend another, maybe 5-10 minutes talking about macro, over what's happened macro in this week. Not that it matters a lot from my investing thesis, but it's good to, it opens up it has opened up my perspective of looking at things and looking at investments, because we are not operating in isolation, right? So things around us do impact the markets. So I do look at, hey, what's happened in the macro. So that's all the topics up for discussion. Anything else you want to know, put it in the chat or raise your hand, and we'll get going from there. All right. Okay, so let's get started, guys. Okay, as always, anything we discuss here is not a financial advice. I want to make it clear. A lot of new people here today. Take it for a little education, maybe a little bit of an entertainment if you find something. I don't know. I mean, sometimes these topics are very boring. Not everyone is interested in looking at finance or the companies and the numbers. So you are a special breed that you spend a couple of hours every Saturday and talk about these things here. Okay. So at a macro level, I think this week, 10-year yield was the driver of the market. And the majority news is we saw 10-year yield, treasury bond yield hit 5%. I think that was the first time happened after 2007. And the stock market sell off, right? For very obvious reasons. If you can get 5% risk-free, I mean, as risk-free as it can get, which is you are loaning, if you're buying a treasuries, you're basically giving money to US government, which is considered to be the safest borrower in the world. And you can get 5% from them as a risk-free, then why to take a risk in investing in stock market? Right. So every time we see that if a 10-year yield goes higher, when the treasury yields go higher, markets will sell off. Nothing different this week as well. Also, I think the Jerome Powell in one of a conference, he hinted that Fed is gonna stay higher for longer, means Fed will continue to keep the interest rate, which is now, I think, 5.25%. I could be wrong on that number, but close to that. And they would like to keep the Fed interest rate over there unless they see inflation really coming down, right? So I think that was the main story. So we saw the rapid move higher in the government bond yield, the 10-year bonds that we talked about. That increase the volatility in both equities and bonds. So S&P sold off. And what else? I think that was the main thing. And of course, individual stocks behave differently, based on if they had earnings or not. But what is driving this yield higher? Right? These yields were close to, 10-year was like a 0.5% to 1%, not long ago. And then Fed has started to increase interest rates. I think since start of 2022, in last, I guess, 18 months, the interest rates have been increased 22-fold, right? It's not like, it's difficult to imagine. And if you're a business owner and dependent on a cash infusion or dependent on a debt, all those equations have now been thrown out. Or if you are a bank or any other corporations who have long duration bonds, right? Those are like, no one had expected after 40 years of low interest rates, no one expected that the Fed is going to increase the interest rate at such a high pace. 5% is not bad. I think if you've been investing or becoming active in market only in last 10 years, 5% seems to be too high. But going back to 1970s, 80s, it was norm, right? 4%, 5% is very nominal. What took market and the businesses by surprise is the pace of increase, right? From 0.25, 18 months ago, now we're talking about 5%, right? So all equations, around buying a house or expansion of plants or machinery or your on your balance sheet, the value of the bonds, all those have gone to toss. But why is it the yields are driving higher? Number one, economy is still resilient. Right? We look last week, employment numbers came out, and we talked about those employment numbers in this meeting. It surprised everyone. It was almost twice of what was expected. So employment is still going strong. Right? So if employment is still going strong, means people still have their jobs, they're still getting their paychecks, they will continue to go out and spend. Right? If they continue to go out and spend, doesn't really matter if the things are a little bit expensive than what they should be. So inflation is not going to come down. And now Fed has got dual mandate that Jerome Powell keeps talking about. And I'll repeat here, a lot of new folks here. One is full employment. Number two is keeping inflation, right? Price stability. So if there is no indication that the inflation will come down, Fed is not going to reduce the Fed rates. So that's keeping the yields higher. Number two is supply-demand imbalances. Now, Treasury Department has been increasing the amount of T-bills and the notes that they are selling in the market. If I recall correctly, and some number may be off, but ever since the last debt ceiling discussion in June, we've added another $600 billion as a debt, as a US as a country. I mean, if US was a company, no one would buy any shares of this company because we spend way more than what we earn. Our debt is increasing, our interest is increasing. And I think now the count is every day we add some 2 or 3 billion additional debt. So if you continue to borrow, and we borrow so much, there's a lot of a supply of treasury bills coming in. So you have to give higher interest rate to entice the buyers to buy your treasury bills. So a lot more supply. So basically, if you want the world to get more and more of your debt, you have to give them a higher interest rate. Right? Third, so you could ask that US has been doing, I mean, we've been issuing debt for long, but why now? Yields are hitting 5%. Reason is one of the big buyers of our debt, of the treasury debt, is saying that they're not going to buy it, which is the Federal Reserve. Right. So this is one side of a government, which is the Treasury Department, issues a debt. The other side of government, which is Fed, will buy a debt. And Fed has been buying the debt. If you look at Fed balance sheet, that has increased during the whole pandemic. But now Fed wants to reduce the balance sheet. So they don't want to buy at the same pace at which they were willing to buy earlier. And if a Fed is buying your treasury bills, then Treasury Department doesn't have to really, I mean, you got a big buyer who will buy at any rate. It's because it's one part of a government buying from another part of a government really doesn't matter. But if Fed is not buying that much debt, if they're focused on reducing their balance sheet, then you have to sell your debt to the external buyers. Right? And they would demand more percentage because there is so much more of supply. Third is another competition from other central banks. US is not the only one who is doing this. Every central bank is issuing debt to finance their governments, right? So all these so-called Inflation Reduction Act, the stimulus checks, where all this come from? It's all being financed by the debt. And every government is doing it. So that's why 10-year yield is going higher. I see a couple of questions. I'll get back to that. Now, are we closer to the peak? Is 10-year yield closer to the peak? So I found this interesting chart, which basically tracks the Fed funds rate in like yellow color. And in the bluish, it tracks the 10-year treasury yield. So again, history may not always repeat itself exactly, but it may rhyme. So if you're looking at a 10-year treasury yield, we see that the 10-year treasury will peak just before the Fed funds rate Fed starts to decrease its rate. So as you can see here in the L1, Fed, the treasury 10-year treasury peaked here, and Fed started to decrease the Fed funds rate. Peaked here just before the Fed started to decrease the rates. Treasury yield has peaked, and we have seen since 1990, we've seen 4 instances of that happening. That gives us, if we have to go by this data, and it's a big if, maybe treasury yield is closer to peaking because Fed is also closer to, you know, keeping the Fed funds rate either the same or is going to decline, right? Market is expecting only one more increase in the Fed funds rate, which is going to happen in November, right? After that, the expectation is for till June, and these things keep changing. Till June, they're going to keep the rates as same, and then probably Fed is going to reduce the rates starting with Q2 or Q3 of next year. So that's what the expectation is. So if that is the case, then maybe treasury yields could be closer to peaking. Who knows? Right? It's a history. We're trying to develop some inference looking at a historical data, right? May or may not pan out that way, but that's the information we can get this from chart. So that's on the macro side. 10-year yield was the story of the week, was driving the markets up and down, was driving the markets crazy. And if you really listen to you know, the tick by tick, the way market reacts, sometimes so hilarious. Jerome Powell will make a statement and market will immediately react to it as if, you know, I mean, from a long-term investment perspective, it doesn't really matter what's going to happen for this year, right? But market is a place where you have all type of participants, and they react to every word or every expression coming out of a Fed chairman. You see a question. Sam asks, how is the recession going to fall? More SFBA layoffs. Bay Area layoffs. Yeah, so I mean, layoffs are happening only in the tech industry. Stack Exchange, a very popular website for those who are in the tech industry, got killed by ChatGPT. They laid off almost 28% of their workforce, almost 1/3. LinkedIn laid off 700 people, right? But the tech employing, the number of people employed is tech is really small. The non-tech areas, still there is a shortage of labor. So that's why labor market is so strong. And as long as that continues to be the case, recession may not be, you know, we may not see recession. I mean, we've been hearing about recession talks for almost 12 months now. From my perspective, this is the most anticipated recession that hasn't happened yet. It's been so talked about. It's been so everyone's waiting for recession to happen, but hasn't happened. So far, it hasn't happened. We'll see. And number two is recession. The onset of recession and the stock market are not always linked one-to-one. Generally, stock market bottom will precede recession. So I'm not going to make any decision based on, oh, the recession has set in. Yeah, that means the market is going to decline. There is no perfect correlation between these. Markets generally are forward-looking. Will probably decline. If you go back into the history, you'll see market generally decline and bottom before the recession. All right. Look at investor sentiment. Like I said last week, I track this more as a contrarian indicator. When everyone is bullish, everyone is ebullient, everyone thinks it's all rosy, then it's a time to be a little cautious, and the other way around. You know, when everyone is so dejected, that's a time to go out and maybe look for some good bargains. So AAII members, what are they thinking for next 6 months? In this week, I think it's all 1/3, 1/3, 1/3. Nothing much you can glean from here. Looking at CNN, fear and greed index, yes, not in extreme fear yet. I mean, the extreme fear, it's a good time to go for some shopping, right? Things are available at a discount. I think stock market is the only market or only shop where people don't like discounts. When things are available on discounts, we tend to run away from it. But when no one is buying, I think that's the time to go and buy the companies that you always wanted to own. Abhishek asked, what is AAII? I think it is American Association of Individual Investors, something like that. Let's search for it. That's more, yeah, and I think so. They conduct a survey among their members to see how those members are feeling. So it's more like retail people or retail. Yeah, it is American Association of Individual Investors. It's a non-profit organization. Yeah, this is the one. So they do publish every week. They do publish the sentiment survey from their members. Okay. So what did I buy or sell this week? Again, this is not an advice, or you shouldn't go and buy these things. But the reason why I share this is we do talk about a lot of stocks, and I also share my portfolio at end of every month. So I just want to be transparent in terms of what I own. I hate, those who come and pump their bags, and then you realize, oh, he was talking about this particular stock because you own a lot of it. So just from being transparent, I come and share in terms of if I bought anything or if I sold anything. So, Asif, I know you're a big Tesla. I eventually bought Tesla. Oh, we've been talking about it for what, almost 3 years, 3.5 years. So this week, I actually bought Tesla. Tesla hit my price point of 220. So I initiated a small position. This is, yay, welcome to the club. Yes, indeed. I always liked Tesla cars, but as a stock, I had never bought any stock in Tesla. I made money in trading Tesla's options. I think that was some decent money I made into 2021 or I don't know, 2020, wherever. But I never bought Tesla from a long-term perspective. So, but this week, it hit my price point. And next, if it falls down to 170, between 150 and 170, that's when probably I'll buy a little more. But now I do have this is what I generally call as a starting tracking position, so that when I look at my brokerage software, or when I look at Think or Swim, I actually see TSLA, and then then anything I need to do, at least it's on back of my mind. So not a big position, not even 1%, not even 0.5%, but this is my starting tracking position. Time to sell Tesla put. I don't know, but yeah, I'm in the club now. You don't have a stop loss in place. I never done any stop loss in my decade of investing in the US, and even prior that in India, I have never used a stop loss. Because stop loss generally don't work. In a long term, stop loss doesn't help you, actually it doesn't stop losses. It actually stops your gains. So I'm not a fan of stop loss. What else? EEM is an emerging market ETF. I already have it in my portfolio. Add a little more to it. TTD. TTD is a trade desk. So I added a little more to trade desk and then sold a covered call. So basically it was a delta neutral position. ARKK got assigned to me. I've been kind of selling covered calls and the puts on ARKK ever since the start of the year, and my stock had got called away at 45, I guess, few months ago, and since then I've been selling the put and then rolling the put, and eventually this expiration got assigned. Same is the case with SLV. SLV, I had a 22 strike. This is a silver ETF 22 strike put that got assigned to me. Again, it had gotten called away from me a few months ago, so I was trying to wheel it, and that got assigned to me. That's it. Didn't sell anything in this week. Abhishek says, with a lot of competitors coming into EV market, maybe a challenge for Tesla in coming years, looking similar to Netflix. Oh yeah, and we're gonna talk about Tesla's earnings results. So market didn't like the earnings, right? If you look at the margins, now Tesla is actually being looking closer to a car company and is being valued like a car company. I know Tesla bulls don't like it. Tesla is not a car company. It's a computer on wheels. It's a tech company. At least the valuation used to be like tech company. It is still expensive from a car valuation perspective, but again, I know one thing: I'll never be able to buy at the bottom and never be able to sell at the peak. So you have to determine what's the price point that you're comfortable in starting and opening a tracking position. So I open a tracking position. If it goes to 0, doesn't really matter. Okay, what did you guys buy? Markets offered some sale this week. Anyone bought anything? Any new stock did you guys buy or add it to your portfolio? So I added one ticker, which is TSLA. MPW. What is MPW? That's a new ticker. I don't think we talked about MPW before. Hold on to MPW. MPW. Medical property. Oh, this is a REIT. Yeah, medical property. This is a REIT. Probably generally people invest in REITs because of our dividends. So dividend yield 21.33%. Okay, I'm a little skeptical of this. Again, this is a stock that I've never looked at. But when I hear any REITs, I do generally REIT investors are what do you call dividend hunters. The reason people invest in REIT is to get a consistent income from a dividend, but you also have to make sure that this dividend is sustainable, means that company generate enough cash to ensure that they will be able to pay the dividend. All right, Abhishek says I did a put on Enphase. Enphase, I think all the solar energy companies are having a bad time. Ever since the interest rate started to increase. So there is Enphase, I think Solar Edge, there is a Nextera, renewable energies. They're all sold off over the last few weeks or few months. Again, I haven't looked at Enphase. I know they have a special those micro inverters which they use, but didn't look at. Haven't really analyzed Enphase as a company yet. The next one, I think what I did start to look at is maybe Nextera, AAII, because they are one of the biggest utility companies. Same is the case with utilities. If you look at utilities, they've been clobbered this year. Again, it's the same case. People want to buy utilities because utilities offer steady dividends. But now the question is, if you can get the 5% from risk-free treasuries, then the attractiveness of utilities or the dividend become way less. And that's the reason that the so-called dividend players, good dividend payers in a 0% interest rates are now all challenged in 5% interest rates because, hey, why do I take a risk if I can get 5% risk-free? And that's the case with the utilities as well. So if we look at the utilities, and I'm looking at it's down 18% for this year. Year to date, XLU. But I'm not looking at an individual company. XLU is down 18%. Utilities is considered to be a grandpa's stock or grandpa's way of investing. It doesn't move. It's not at all volatile. It'll give you standard stream of a dividend income. there is no fun in it. There is no, you won't see it peaking or going through the troughs based on what Fed says. Pretty standard one. But this year, it is down almost 18% because the dividend, the attractiveness of the dividend from utilities is far less now. Narendra says bought LCID. That is Lucid, I guess. Yeah, I'm not a big fan of Lucid just because I think I saw somewhere, but if you look at how many cars they are selling, as a car company, look at every car company, Tesla or any other EV company. If you go out of, here you go to Tesla, then you got Ford is not entirely just an EV, Ford and GM. But if you look at pure play EV companies outside of US, they all have been selling more and more cars. As a Lucid, the number of cars being sold has been going down quarter after quarter. So I'm not a big fan of Lucid. They may have a tough time. In a sales of 753 million, they lost $2 billion. Right. So it's only time will tell, is Lucid gonna be a next Tesla? Or is Lucid gonna go the Dodo way, Lordstown motorway? Right? There was a lot of EV companies that came public in 2021 when there was a lot of money to be thrown around. Now it's a test of time for all those companies. TLT down the drain, same case with TLT. I mean, all the TLT is a long duration bonds. So any long duration bond has been hit really bad. And the longer the duration of the bonds, more is the hit based on the interest rate movements from the Fed. Okay? So TLT is 20 years plus long duration bonds. It's an ETF that holds 20-year and plus. So that's down exactly 18%, almost 18%, same as XLU. Same story. Right? AT&T, ADT, again, a good dividend. So Anand, you seems to be a dividend hunter guy, because again, anyone buying like AT&T is buying probably because of dividend. But from a stock perspective, I think even though folks probably have earned in dividend, but they would have lost a lot more in the capital, on the capital side. Ramesh says sold puts for ISRG, Amazon, Nvidia, call for Applied Materials, Broadcom, Target, ASML. Cool. Sorry, someone is trying to say something. Okay. Oh. All right. Okay, so let's move on. Next, what we're gonna talk about. Yeah, this is the one. I think I put it on the separate WhatsApp group. So I read somewhere 6.5% in CD. I'm like, I mean, I have a CD which is close to 5%. I have a savings account which is paying what, 4.5%, plus I have a T-bills which are paying 5.5%. 6.5% guaranteed in a CD. So in fact, there is one. So if you look at Financial Partners Credit Union, and I will put this link in the chat, so you can go and see if you find something of interest. But Financial Partners Credit Union, 8 months, it's actually paying 6.5%, but I think they have a max limit of $5,000 or something. But then I looked at others, right, which are probably not bad. If you're looking at 18 months, you're still 6% for 18 months, still not bad. So would you invest? When you can get 6.5%, which is guaranteed by FDIC, would you invest in stock? I think that's a question everyone is contemplating. And that's a reason why we are seeing that big money, when I talk of big money, means the money from pension funds, from endowment funds, who have a hurdle rate of 6%, 7% that they need to finance their operations. If you're a pension fund, you have a pension liabilities, right? Which you have to meet. Legally, you have to meet. Right? So now the question is, if your pension liability is 7%, you can get 5.5% from risk-free treasuries. If you go a little further on the risk side, you can get 9% in high-yield corporate bonds. If that's the case, why any pension fund investment manager would take a risk to invest in a stocks in which you don't know whether you're going to get or not? Bonds, you're contractually, you're legally bound to get that, right? Unless the company defaults. T-bills, you will legally, unless the US government default, then I think all bets are off. Then the stock market is going to get to zero. You'll get 5.5%. So that is why, if you have not read it, maybe you should read the Howard Marks memo, Sea Change. He published the recent one. It talked about, I think it's a part 2 of a Sea Change. The first one, I think, was in April, May timeframe, somewhere March, April, May. That things have changed. The strategies that worked in a 0% interest rates may not work, will not work if you have interest rates which is 5%. Right? When the credit investment, investing in a credit, you can get 6%. You can get 6% in bonds. You can get 6% in CD, right? Then the attractiveness of investing in a stock, which on an average give 8 to 10%, goes down. And that's why we see the impact of every time the bond yield rises, stock market will sell off. Nothing new in that. It's a rational decision. So am I going to do this? Not. I think I'm still holding my treasury bills. You don't have to pay local state income tax on those. Those are exempt from state income tax. So I think I'll continue to hold this. But at the 6% for 18 months, that sounds very attractive. We'll see. So that's all around risk-free 6.5%. Anyone found anything better? Do let us know. All right. Now coming to our first main topic. We are 45 minutes into the session, which is continuing from our previous discussion on investing journey. So we're gonna let me just build that up, do a quick review, and then we'll jump into investment, or how do you analyze a particular business. And I'll take a live example, and we're gonna go through that analysis together. Okay, makes sense? And then after that, we'll jump into the earnings of Netflix, ASML, and all that stuff. Alrighty. Okay, for those who joined here today for the first time, you can go and look into the recording of a previous session, which is available on my website. So last week, not last week, we didn't have a session last week, but prior to that, in my previous session, I already covered, if you are new to investing, we talked through some pre-investing checklists, how you should, think about investing as an individual investor, there is a way how you could construct a portfolio, which one is a passive portfolio. We talked about mutual funds, ETFs, some examples of some ETFs, right? And now, as I said, in the next session, we're gonna talk about what if you want to invest in an individual companies, right? And let me put it this way. There is absolutely no necessity of investing in individual companies, especially in the US, right? I know when I was even in, other countries also, probably there are instruments which will allow you to invest in, low cost mutual funds, the ETFs. I think, but US capital market is pretty mature. So there are so many ETFs available. There are more than 3,600 ETFs. There is, like I said last week, there is one ETF for everyone. You like gold, there's an ETF for it. You want to invest in silver, there's an ETF for it. You want to invest in oil, there's an ETF for it. You want to invest in tech, there is an ETF for it. You want to invest in space, there is an ETF. You want to invest in commodity grains, there is an ETF. You want to invest in water, there is an ETF. Nuclear, there is an ETF. Uranium, there is an ETF, right? But so you could construct your portfolio using ETFs. But if you want to beat the market, or if you want to also are interested in becoming a better investor and want to invest in individual companies, then you need to know about that company, right? So where to find information if you want to learn about that company? Now, these are the sources, some of the sources that I've listed. EDGAR, which is SEC database. By law, every listed company has to provide their annual reports, proxy statements, 10K, 10Qs. You can go and get all that into EDGAR. I first start with the company's investor relations section, right? A lot of companies are reported quarterly results. We're going to look at that. All I did was go to their company's investor relation, download their earnings report. There are other websites where you can find information about company: Finviz, Guru Focus, Fool, Stratosphere. Your own brokerage firm could have. Fidelity has some good material. TD Ameritrade has a material. Seeking Alpha, Zacks, Benzinga, Twitter, I should say now X, right? YouTube, plus, meetups like this. There are many other channels. So not having information, you don't have an excuse of, I don't know about this company. I think the only reason you don't know about this company is because you don't want to know. There's so much information available. Gone are the days wherein companies, you need to know someone in the company to know about what's happening as a business. Right? Today, even as a retail investor, after the regulations were passed in US, companies cannot disclose anything privately. They have to, if it is a public company, it has to be in the public domain. Right? So as a retail investor, we have all the information, as much information as any sophisticated Wall Street analyst or the Wall Street firm has. The question is, what are we doing with that information? That makes all the difference. It's not the lack of information, it's what are we doing with that information. Right? And what to read? Investor presentation. So I like that. Some companies actually have their investor meet. It is different from their earnings meet. And then they talk about what they're going to do in future and all that stuff. That gives you more insight into what this company is thinking about 3 years, 5 years down the line. Annual report, quarterly earning report, proxy statements, websites. These are the different sources for information. Right? Try a few. You may like one, may not like another one, right? But again, after you're trying a few, now I know where I need to go and hit and where I can find information, right? And I'm always learning. There are so much information coming out in the market. Every few months, you will find a new website talking about how easy it is to analyze on their website as compared to others. So, but some list of the websites that I have used. All right. So now, continuing on this one, I'm gonna analyze a particular one stock, take you through the process of how at least I go about analyzing a business, and then decide whether I want to invest in this or not. Right. So those are the ones which is, if I want to invest in, I want to invest it for a long term. My long term is minimum 5 years, right? Ideally, never sell. And we're going to talk about how to stay married to your stock, maybe in the next session. So how to stay married, how to reduce the capital, and in some cases how to divorce and what's the reasons you could divorce with the stock. But today I just gonna focus on, this is your dating period, where you're dating a lot of stocks, trying to learn about the stock to see, do you really want to enter into marriage or not? So this is our dating period. And let's date a stock. I think that I talked about it maybe 2 years, 3 years ago. I think that was probably when it came IPO in 2021. So let me just pull that out. And so the stock that I want to talk about is Coupang. All right. How many of you have heard about Coupang? Don't Google it. I have not. Okay.
It's a Korean kind of like Amazon type of thing.
Yeah. We're gonna talk about it. Amazon, DoorDash of Korea. Yeah, Abhishek, you're right. All right. Yeah. So it is called Amazon of Korea. Like, I don't know whether we should use it that way, but that's how generally investors have become very comfortable to. Netflix of China, Netflix or PayPal of Latin America, right? Amazon of Southeast Asia, Amazon of Korea, like Flipkart is Amazon of India. Right? Anyway, so this is the company. Used to be a South Korean headquartered company, but recently moved to US, listed and trade on US exchanges. So we're gonna, like I said, I had analyzed this stock when it came to IPO. So now we're gonna do it again. I hold, from a disclaimer perspective, I hold this in my portfolio, and every time, yeah. So first time we analyzed was in March 21. And then I think September I initiated a position, and then blah, blah, blah. So let's see. Now let's gonna do a re-review of it. And this is a process. If you're interested in individual stock, you need to put in the work, right? So this is the work that should go in, or any variation of this work should go if you want to invest in any stock. So first, about the company, what this company does. It's founded in 2010 by a Harvard School dropout, Baum Kim. He came to US when he was 8 years old, and then got supposedly bright enough. He got enrolled into Harvard Business School, but then dropped to start Coupang. It is a Delaware incorporated company. It was headquartered in Seoul, South Korea, but moved to Seattle in 2022. So now it is US-based company. Initial investors were SoftBank, BlackRock, and Fidelity. And now I think I have SoftBank still owns 1/3 of a company post-IPO, and then the other are Green Oaks Capital. And then there are some family offices who own Coupang, like Stanley Druckenmiller, very well-respected investor in US. I think Bill Gates family office own Coupang. Stanley Druckenmiller own Coupang. Belly Gifford, best known investor for investing earlier in Teslas and a few other, forgot the name. Again, very well known investors. They also own Coupang, right? So what's their mission? Now, to find all this information come from their website or some of the other sources that I mentioned, right? So your initial IPO review in the US, every company who goes for an IPO has to file an S1 document. So let me just share that. So, or it has to be, if it is not a US incorporated company, then they have to file F1. So it's a lot of information available about this company in this. So this is one document, S1 document, which is, if it's a new company, should be the first source of information for us to analyze the company, because hey, it's a new company coming to the market. There are no financial results to look at. As companies matures in the market, you see more and more information available on their website. Okay, so what's their mission? Their mission statement is to create a world where customers wonder, how did I ever live without Coupang? Little bit cheeky, but I get the point. Is, I mean, today, if Amazon goes out, or if Amazon is not there, the generation think, you know, the new generation always think, Dad, how did you survive when Amazon wasn't there? Right? You had to always, you have to go to the shop to buy these things. Like, so same is the case that Coupang wants to say, how they want their customers to wonder how they survive, ever live without Coupang, right? It means they want to have this, they want to offer the services and delight customers in a way that you just have to have Coupang. So what is Coupang? It is known as Amazon of South Korea, right? And they also, I would throw in the Instacart and DoorDash also, because they do groceries and everything else. They also do food. They have warehouses in over 100 locations, and they own all those warehouses in over 30 cities. If you look at South Korea, the landscape is unique. 70% of the region is mountainous or uplands, and only 30% in lowlands. So trying to build a logistics network is challenging. And again, in the US, we have well-established logistics companies. We have a FedEx, we have a USPS. Forget about Amazon. Even when Amazon was starting, you still had USPS. You still had UPS, you had FedEx already available to ship the goods. Not in all countries in the world, right? Countries like South Korea, countries like India, you don't have that great logistics network. So Coupang started to build its own logistics network, ever since they started the business. So now they build the warehouses, like they got 100 warehouses in such a way that 70% of the Koreans, they actually live within the 7 miles of one of their distribution center or warehouse. And that is important, because last mile logistics is, the logistics is a big cost for any e-commerce operation. And last mile logistics is always challenging. The reason why Amazon is building its own logistics is because it's costly to always depend on FedEx and USPS. So, but Coupang had no choice. Korea didn't have such a great network, so they had to build everything from their own. They are also focused on, do good to environment. So they basically are reducing the need for cardboard boxes, bubble wraps, and they're delivering groceries in reusable containers. But how is it different from Amazon? Is if I were to buy something from Amazon, if I have to return it to Amazon, to me, the easiest is go to the Whole Foods and go and return it at the Whole Foods. But I have to go. Or you can go to UPS and return it, or you can go to Kohl's and return it. But if I'm a Coupang customer in South Korea, all I need to do is to keep the stuff outside my door, and the Coupang employees, the delivery people, they'll come and pick it up. That's amazing. Right? Now I know, okay, how did I ever live without Coupang? As of end of 2021, they account only 9.8% of South Korean consumer commerce. So there is a lot, even though they are the biggest e-commerce player in South Korea, but there is still a lot of room to grow, because the e-commerce itself is a smaller portion of the overall consumer commerce. So it's not even 10%. They employ 63,000 people, which I was a little surprised to see having so many employees on their roles. But then I understood why where they are different from Amazon. The other way they are different from Amazon is Amazon has mostly, they have a lot of a contract labor. They have a lot of a temp employees that they employ, the delivery people, folks working in warehouses and all that stuff. Whereas Coupang all has employed, all the delivery people are their own employees, right? That's why the number is 63,000.
Vivek,
Go ahead. Right. Let's continue.
Vivek, there's something in China, Shanghai, Beijing, Shenzhen, that they might have it in Korea. They have kids. Oh, excuse me. People like 18-year-olds to like 35-year-olds. They're on motorbikes delivering stuff. I don't see motorbikes in San Francisco. So they probably do that in Korea too. They have motorbikes delivery.
Oh yeah. So maybe I don't know, and I don't know if there are like an 8-year-old driving motorbike. Is that a hearsay?
I said, excuse me, I said 18 to
35.
35.
18-year. Okay, got it. Yeah. So then I'm sure. I mean, over here we don't have. But if you look at the topography of Korea, it's a very densely populated cities in Korea, right? It's unlike US, which is spread out. The cities like Korea, cities like if you go to India, Delhi, Mumbai, very densely populated. Right? Taking a car or a truck is impossible. All the delivery services that I'm aware of, my family uses in India, like Swiggy, Zomatos, and Flipkart, the guy comes on a motorbike and delivers the stuff. So I'm not surprised that they might be using motorbike to deliver it. That's probably the most efficient way to deliver the goods, right? Okay, so I'll skip. Yeah, I think I already talked about it. It came to US when I was 8 years old, then dropped out of Harvard to build Coupang. Okay, this is a letter which he wrote to all our, as a part of their S1 document. I'll skip this and talk about, when we did S1 review, of course, we went through it. But let's talk about, so we talked about Coupang. Let's also talk about how the business environment looks like, right? Korea is the 4th largest economy in Asia and 17th largest globally, with a GDP of 1.7 trillion. So it's overall, the market size is I would say it's a decent market size, right? It's the 17th largest global GDP. It's also tech savvy. If anything I know of, the South Korea, any new tech related to telecom, mobile, actually South Koreans are the first one to adopt it at a larger scale than US, right? US is far behind. So the South Koreans, they are very tech savvy. It is a super dense country with 50 million people living in, and the high internet penetration rate of above 90%. Like I said, Coupang all still is a small percentage of overall e-commerce. The total e-commerce spend was 128 billion in 2019 and expected to grow 206 billion by 2024. So this is a market. They're operating in the market or in the business which is not saturated. It is still growing. Right? I won't be interested in a company which is now in a declining market. So that's why it is essential to look at the business or the market that they operate on. Now let's talk about their products. Right? What do they sell? So we looked at the origin of a company, what's the mission that they have. And the reason I also look at a mission is mission also ties all the employees together. They give a direction to the company where the company wants to go on. I don't think it just as it's a lip service. If they're doing a lip service, that's bad, but at least should have some mission that you can use to drive all your rest of our organization focus on it, right? Keep all of them in line with what the company is trying to achieve. Then we looked at a business environment, looked at, this is a really big market for them to even play with, right? Let's talk about their products. So from a product perspective, they have a next day or even faster delivery. So in US, we have a like 1 day delivery or same day delivery, right? Same as the case here, next day or even faster delivery for nearly almost 100% for their orders. What's interesting is they have a last order by midnight. Means, say your kid comes from school, you come back from your job, finish a dinner, and then you're talking about it, and suddenly kid says, oh, I need this, what a drawing book for my class tomorrow. You're in a fix now because the shops are closed. What do? What Coupang allows you to do is, if you place an order before midnight, it will be at your door at before 7 a.m. So this is something which, again, Amazon doesn't do it, but Coupang is able to offer this service, which is midnight order delivery at your doorstep before 7 a.m. They, just like Amazon Prime, they also have a Rocket Wow membership, and in which you're gonna get unlimited free shipping with no minimum spend. So the more I look at businesses, I think it's, when it comes to the e-commerce, almost all businesses, whether it is Amazon in US, whether you go to Latin America and look at Mercado Libre, you go to Southeast Asia and look at C Limited, you go to Korea and look at Coupang, go to China and you look at Alibaba and JD, you go to Africa, look at Jumia. Almost all the e-commerce delivery or e-commerce-based companies have the similar business model. They are all following the model that Amazon had followed because they've seen the success of Amazon. Right? So you have your, same as Amazon Prime. Then they have a dawn and the same day delivery. We already talked about it. Then they also moved into Rocket Fresh, which is an online grocer. Right? You can deliver groceries if you want to. Like I said, they offer hassle-free returns. Amazon doesn't do it. It is just leave the package outside of your home and some associate will come and pick it up. They also started with Coupang Eats. Right? Amazon doesn't do that yet, but just like we can talk about, that's why it says this is a combination of Amazon plus, let's say, DoorDash. So this is the largest online food delivery service in Korea. You can order food on Coupang. Then they also have a Coupang Play. Right? This is the Amazon Prime Video service, in which you have a subscription-based video streaming service. And these are kind of a little bit new business. Eats and the Pay. Eats has been around for some time, but Play has been a new business. Then they also have a Coupang Pay, like Amazon Pay. Amazon Pay really didn't work it well, but if you look at Mercado Libre, Latin America, Mercado Pago is one of the fastest growing digital payment system in South America. Right? But so they've been really, really very successful through that. So Coupang Pay is doing much better than Amazon Pay because, and they all right now they spun it off as a separate subsidiary. So anyway, the results from this doesn't directly impact Coupang, but this is the second most widely used pay system in Korea, which is great. They also have a Coupang Flex, and this wasn't there when we did an initial review during IPO. So the company, let me see, I made the changes. Yeah, these are the three things that were not there during the initial IPO, but now, so company is adding more services. So the Coupang Flex is for, that provides temporary employment to anyone above 18-year-old. You can pick up just like I would say TaskRabbit kind of job. You can pick up phone and say, I'm available from this time to this time, and you can pick up the packages and deliver. And then they also have advertising as a business. to like Amazon also started doing advertising, and now it's become a bigger and bigger part of the overall business. Coupang also offer advertising to supplier and merchants to advertise on their websites. So these are all the for consumers. Now, talking to merchants, of course, they'll help merchants to do customer to product matching. I mean, they have to do everything to make sure that the products are the customer get the products that they're looking for. They mine all the data based on the customer shopping habits, and they'll say, okay, if you bought this, you may also like this. The people who bought these things also bought these things and all that stuff. So they do all of consumer to customer to product matching. What they also offer is a fulfillment and logistics by Coupang. This is similar to, and I'm gonna again go back and get a comparative example from Amazon. This is similar to what are fulfilled by Amazon, right? So if you buy on Amazon.com, the goods are not always sold by Amazon. It can be sold by other merchants, but the delivery and the fulfillment happens through Amazon. So they also have this FLC program, wherein they could the fulfillment of the order and the whole logistics of that will be managed by Coupang. Then they also provide solutions, marketing solutions to the merchants, which means advertising tools, being ability to create a campaign. You want to give like 10% off for the next 4 days and see how what's the change in the sales. You can do all that stuff, and of course provide an e-commerce storefront, just like Amazon has a store in store. You can go to Nike store. I don't know if Nike has a store in that, but probably Nike is moved to Shopify. Again, I don't know. But in Amazon, you can go to any stores, right? Each brand can build their own store in Amazon. Same is the case on the Coupang, right? So basically focused on the things that consumer would buy or consumer is interested in, and the things that the merchants and the suppliers are interested in. All right. 360-degree stakeholder management. I like that. In a part of the world, and this is probably surprising for US-based folks, but 9 by 9 into 6 is the norm. China, India, I think Korea, I think Japan, the work culture is very different, right? You work for 6 days, 9 to 9, 9 a.m. to 9 p.m., right? But the Coupang, they specifically instituted a policy not to work more than 52 hours per week, right? Which is very different. I'm looking at I'm sure someone from EU side, Europe side will be like just faint over the prospect of working 52 hours in a week, right? They are looking at like 4-hour work week, 4-day work week. They also classify all delivery personnel as their employees. That's why they have 63,000 employees. I'll skip the financial data right now. I'll go and maybe look at a financial data of the recent quarter, right? But they've been, I just picked up the annual side. They've been increasing their revenues while reducing the losses, which is what, as an investor, I would like to see. I agree, when you start an e-commerce business, there will be a lot of a cost that you have to incur, especially building up the warehouses, building up the logistics network, and to grow your business. But over a period of a time, if you can grow the business while reducing your losses, then I do see that eventually you're going to make some profit. Right? Eventually, that's a goal. At some part of a time, I want my investment to make a profits and start returning those dollars to me. So far they are on right track, I would say. They've also been focused on cash flow, and this is very specifically, they came from the CEO during the earnings call is, our management goal is to increase the free cash flow without share dilution, right? Which is great. Not all management is focused always on increasing free cash flow. some managers are focused only on increasing revenue. Right? Nothing wrong in that, but not all revenue increase is good for shareholders. Not all revenue increase is accretive to shareholder value. Many times they actually destroy shareholder value, and I don't want to like that. But Coupang, I like because they're focused on increasing free cash flow. Initial years, a lot of FCF was impacted because of investment in building out the logistics network. Like I said, there is no FedEx, no UPS equivalent. So they have to do everything from scratch. But now the free cash flow has been improving. So increasing revenue, lower losses, higher free cash flow is what I would like to see. All right, what else? Skip. So this competitive position, right? So now we talked about the company. We'll look at its financials. We look at the business environment it operates in. Now look at the competitors. What competitors do they have? So they are the largest directly employed delivery fleet in the country. So this is a moat that they have, right? From a competitive positioning perspective. Coupang is not only the current market leader, but it is the only player making major market share gains. Right? So there are other competitors in the market, looks like G Market, 11th Street, Auction, and all that. But it's not just the biggest, but it's also increasing its moat against these competitors. Right? Despite its high market penetration already, Kim said Coupang still has two main areas of growth, which we already talked about, Rocket Fresh and Coupang Eats. And I'm going to talk about Coupang Eats a little more in the recent earnings call. They again talked about it a lot more. So in last 2 years, this has become much bigger business. Right? Management skin in the game. I didn't find the information, but it is good to know. Again, want to look at this to know how much is management incentivized to increase the shareholder value. If they themselves have a lot of stock options as a part of their pay package, or they own a lot of stock options. I think Bom Kim, he owns decent amount. I think I had some numbers up of like 4% or something, which is decent. So management will be incentivized to increase the value of a share. So it means we are both on the same side. So it's important to look at the skin in the game. Risks. What are the risks they have? One risk which I foresee is a high fixed cost. Right? But they have invested into warehouses. They have delivery folks as their employees. And if you have those as an employees, whether business is coming or not, you still have employees on your payroll. I mean, you still have a warehouse. You can't just sell the warehouse and then buy it again in 2 months, right? Like on the US, we see a lot of these retailers, they'll have a temp employment for 2 months, right? Hiring for the next, during holiday season, you'll see all of these retailers hiring a lot of contract workers and then laying them off after the festival season or the holiday season is gone. But if you build your own warehouses, if you have own employees, it may not be that easy to do it. So that's one area of concern is if the business starts to decline, their cost base is higher. They have a high fixed cost. Right? It's a dense and congested metropolitan market, so drones won't work, right? So means you still have to have folks coming and delivering it, so that the cost pressure will be there. And the third thing is, since it's in the majority of its operations, or not majority, all of its operations and income is coming from outside of US, so it will be it will be impacted by forex fluctuation, right? If a dollar is strong, we will see the dollar-based, dollar-reported earnings will go down, and if dollar goes down, then you get the bump. So any company earning revenue in non-dollar is always will be impacted by the foreign exchange fluctuations. So these are some of the risks that I see. Anything that we should be aware of, any management misfits, nothing. It's a clean management, no corporate shenanigans, no financial, hiding stuff, etc. So, okay, I can skip this. This was during the IPO review. So that's around trying to understand. We are not done with the whether I should buy this or not. This is just trying to understand more about the company. Then you can, at least I would like to build is my scorecard of the company and see where does it rank on that scorecard, right? So let's do the scorecard again. No, this one, where's my coupon one? Just give me a moment. Okay. So based on what we know, and if we are still missing some information, maybe we should find it. This 21st, right? All right. So let's give it some rank. I see some question unrelated to coupons. I'll get to that. So evaluating business mission statement. Is it simple, inspirational, and optionable? What do you think? Their mission statement was how did to make customers wonder, how did I ever live without coupon? I think it's concise. I've seen a mission statement which are like 4 statements long, 4 sentences long. So I would say this is concise. It doesn't restrict them to one particular kind of a business. So it is optionable. It doesn't say that delighting customers only by selling e-commerce, by selling online. So I am tempted to give it 1. Feel free if you have any other opinion, right? Now look at a moat. What kind of a moat does this company have? And when you talk about moats, there are a few things that you can look at. Moats come in a different form factors: network effect, switching cost, cost advantage. So network effect is when any additional consumer or customer on your platform enhances the value of existing customers. Does Coupang has a network effect? To some extent, I would say yes, because if I join Coupang, and I add my reviews on it, or everyone else is benefited by that. So, but I would say I'll give it 1. Switching cost. If I'm a customer, which is my switching cost to switch to Coupang competitor? Is it very low? Or is Coupang doing something which other competitors don't offer, and hence my switching cost is high? What do you guys think? I mean, we went through the business and we looked at it. What do you think? What the switching cost? Okay, 1, 2, 0. I do think they have a switching cost in terms of their dawn delivery, midnight delivery, and the fact that they have 70% of the people live within 7 miles. So they are able to offer these services. So AM says 1. Okay, let's give 1. Durable cost advantage, scale, distribution, physical location, vertical integration. So I think I would say I'll give them 2 over here, because they built a scale, they built the whole distribution network that they own and not dependent on anyone. And They have access to 70% of the South Korean population within 7 miles. Intangibles. How about the brand, patent, trade secret, license that no one else has? Only thing I think while I was looking at a coupon is a brand awareness. I don't think any specific patent. Eventually, they are selling goods on internet. That's not a patentable. I don't think there's any trade secret, but they do have some brand value. So let's, I'm tempted to give 0.5. Is the moat, is it narrowing, it is stable, or are they increasing their moat? Fine, moat is there today, but is there moat decreasing? Then we know, going forward, they will have challenges. Or are they doing stuff to increase their moat? Looking at the additional services that they have been offering now with Eats, and then with the Flex, wherein they are able to get more and more delivery personnel at lower cost, I would say they are increasing their moat. We'll start with that. Optionality. Well, I think Coupon not just have optionality, they actually already demonstrated that it's not only good delivering e-commerce goods, but they moved into Eats, they're moving into Play. So I would say I'll give them 2, not 3. Counter positioning. Counter positioning is something that if your competitors try to do the same thing, competitors will be hurt. I mean, except the first one, which is building a logistics network, which will consume a lot of which costs a lot of money. I didn't find anything which is counter positioning here, so I'll skip this. No numbers for this. Financial health. Do they have a cash to survive through rough weathers? So let's look into their I think let's look into their recent quarterly balance sheet. So they have a $4 billion worth of cash and cash equivalents. And from my expenses perspective, their operating expenses is $1.3 billion. So they have almost 3 years worth of operating expenses as cash on their balance sheet. This is as per their latest quarterly results. So I would say they do have cash. How about long-term debt? How much long-term debt do they have? Total long-term liability is $1.9 billion, not too much. Right. So I've seen the worst debt position, so I won't penalize them. It's not too much a long-term. How about their gross margins? How are their gross margins? Now, remember, this is a retail industry, not a software industry. So generally this one, negative 30%, 30 to 70% give 0, and more than 70% 1 is applicable for software industry. For retail industry, I'll be little more lenient in avoiding the grade. Because Amazon doesn't make money on their e-commerce business. It's not easy. So let's look at where I think it will be there in their income statement, gross margin. There we have a gross margin, 26%, which is decent. That's good. So 26% for this retail business is, I would say that's good. So I'll give them 1. Return on equity. Is it low, average, or high? What's their return on equity? I forgot where it is. The cash flow or income statement. I did see somewhere. Okay, so the right now it's return on equity is negative. So yep, that's not good. So 0 for it. Employee rating. So unfortunately, I mean, I go to Glassdoor to look at employee rating. So let's go to Glassdoor. But this is not a US based company, so I don't know if Glassdoor will have this or not. Door.com. Let me log into Glassdoor first. Okay, so in interest of time, let me be neutral here, because this is not a US based company, so I don't think they'll have it. Founder +1 if it is involved, more applicable for newer companies, so I'll give them 1. Bomb Kim is still involved. Management ownership, we didn't find, I mean, Bomb Kim has around how much percent? I think I had that number. So let's go on the top. I had that number. How much does he own? Oh, owns 10%. Okay. So that is, they get +1 here. Risks. Let's look at the risk. Any customer concentration? There is no customer concentration. They sell it to millions of consumers, not one consumer. Are they dependent on kindness of others? Right? No, they don't have a long-term debt. They can self-finance themselves. So I don't want to penalize for that. Industry disruption? No, they are the disruptors. Any outside forces, commodity prices, interest rates, strong economy? I would say not too much from their business perspective. I'm not talking about stock price. I'm talking about their business. Because they just deliver the stuff. They don't make the stuff. So if there is a margin hit, they're not the producer of those goods. Extreme dilution. How about the share count? No, there was no dilution. Not much of a dilution. It was less than 1%. Revenue growth by acquisitions only. These are the managers which I don't like. They want to increase the revenue, but without adding shareholder value, they could just acquire another company. So if you see any company growing their revenue because they keep on acquiring other businesses, the tentacles should go high. Not all acquisitions are bad, mostly turn out to be bad. So you have to really see how they're growing the revenue. Management misfits? Nope. Any geopolitical risk? This is this is South Korea, not North Korea, but so I wouldn't say there is a geopolitical risk. Any currency risk? Yes. But I don't know. I mean, the currency risk is just the risk that dollar the South Korean won becomes, or dollar becomes stronger against other currencies. I don't want to this is not a currency which devalues like crazy, like we see in, let's say, Venezuela or other countries. So the currency risk is for those wherein the governments, like Italian lira, right? You devalue like 25% in a day. I don't think we have that risk with Korean won, or at least I'm not aware of. If it is, if you guys know that Korean won has been pretty bad, I haven't heard any news around the Korea, so I would not penalize them. High executive turnover, didn't see that here. So from a risk perspective, not much of a risk. So let's total up. What does this sum up to be? 12.5. So 12.5 means I need to get a little more confirmation. So little more research is required to hold on. Yeah, see 2 to 12. Yes. So need little more research before I invest in it. I think it's almost at the border. So I would say if there is no negative news, then I could actually invest in this. So this is okay to have a starter position at this point of a time. So if it is below 9, I'm like, I don't want to waste my time on this one. Between 9 and 13, get some confirmation before investing. Little more research may be needed. So right now it's at that stage. Right? I do want to go and see, is there anything that I missed out? Is there like counterposition? I don't know whether they have or not. Is there anything that I missed out that I need to go and focus on? But at this point of time, I think it's okay to do an initial starter position so that it's on my back of the mind. I need to go and further study this company. Okay. Now, so let's look at this. So this is like one area where I find out, okay, is it investable or not? Now, I also look at the second part where I say, if this is investable, how much it should go in my portfolio as a starting position. From when I start to build my position in this particular stock, how larger should I be building? Should it be restricted to 1%, 2%, 5%? That's where I look at these accelerators. Is it on a SaaS or a recurring business? Okay. I'll skip this because I still have to do a little more work here to make sure that, hey, I really want to build position in it beyond the starting position. But these are things that I would want to look at. There is the revenues recurring, right? Or do they have to dig the well every quarter to find new water? Is this company pass my snap test? The only reason I invested in Uber, even though the Uber stock performed bad, Uber was unprofitable because it passed my snap test. If this company disappears, will the consumers feel the pain, right? You snap your finger and boom, the company is no longer there. Does it impact the consumers? In case of Uber, yes, it does. So, and then I started building position in Uber. You look at a revenue, have they been increasing their revenue 3 years, right? Net income, are they profitable or not? Free cash flow positive. In this case, they are cash flow positive. Revenue growth, is it better than industry? Shareholder friendly actions, are they doing things that are better for shareholders? Are they buying back the shares? Are they giving dividends, right? Are they growing dividends? How about their valuation? How about the competitive marketplace? Have they built a good ecosystem, right? Does the management beats its own guidance? Do they pride in beating and raising their guidance? And what kind of customers do they have? Now, based on these, my accelerator, I will see how much do I want to make it a portfolio. Should I go slow on this one, or gosh, this company is great, and if you find some great companies, then yeah, I want to have it a bigger position in my portfolio. So that's the accelerators will define it. So right now, I think I'm here. I probably need a little more analysis to see if it is really worth building a position beyond a starter position. So that's around, I would say that's how you do your investment research process. I know last week someone asked you, can you take us through how do you do the research? So that's where it is. So as a part of our being a good retail investor, once you decide you want to invest in an individual company, make sure you understand that company. This is one process in understanding the company. And now it doesn't finish here. You have to continue to understand it even more next time they come with their own quarterly result. Because I remember when we did the first time, way back like 2 years ago, or 2.5 years ago, the score was a little different. It was in the category of, yeah, go ahead and invest it. But now things have changed. So I need to go back and look at what has changed, why the score is not the same, and see if am I missing something. So that's what we'll talk about next week. Is once you now we look at the dating process. So I invited Kupang on a date. We talked about stuff. got to know Coupang more. Now, once I marry Coupang, means, hey, I want to own in my portfolio. Next week, we'll talk about how to stay married with the stock and what to do during the marriage with the stock. And then finally, if there are reasons to divorce, what are some of the reasons for divorcing the stock? Okay. You're not going to get any marriage advice, relational marriage advice. I can only talk about stock marriages. Okay.
Vivek.
All right. Oh, yeah, go ahead. I was trying to look at some questions.
Oh, most of it's my questions or comments, but I put in a low bid on Coupang. The thing I could do now is some of the option strategies you taught me.
Oh, okay, so that's working. That's good.
No, I could do it now. If it buys it, I could, start selling calls and low puts.
But you could, yeah. See, again, the thing is, now if you feel that, yeah, you want to own
Yes.
the stock, then we will talk about what's the different process of owning the stock, right? Buy the stock outright, or number two is sell a put, or number three is buy a call. These are the three ways to get bullish exposure to a stock, right? I generally want to start with a small stock position, and then start beyond that, start building stock position and then start adding options on top of it. I do own Coupang in my portfolio, and I have a strangle position on it already. All right, let me look at some questions. Jay asks, what do you see outlook of big tech, especially Google, Alphabet, Microsoft, overall tech sector, FANG? And of course, give you your take on NVIDIA, investment in NVIDIA midterm, 3 to 5 year horizon. All right, so from a big tech perspective, and again, I can only talk about the business. I don't know how the stock will perform, because stock will perform based on what's in the mood of Mr. Market today. Right? And that today could change on everyday basis, right? And some of them may not have anything to do with Google, Alphabet, or Microsoft, or NVIDIA. So from my perspective, I think the Google, Google as well as Microsoft, the earnings should be good. Even forget about this whole Q4. Now in Q3 and Q4, the earning guidance have been increasing as compared to the previous 2 quarters where the earnings were shrinking. So now we are looking at earnings expansion. All the layoffs that these companies have done last year, and all those charges will be now coming off. So I expect the business to still be okay. Stock is a different ball game altogether. When it comes to NVIDIA stock is the one which I think has got egregiously overrun. And again, I could be 100% wrong. From a short to midterm, I think 3 year, 5 year NVIDIA business is still fine. But again, this is my belief that they will never be able to have the margins that they're having right now. Competitors will eat them, or Googles and the Microsofts of the world will figure out, guys, why do I need NVIDIA? I'll have to build this in-house. So their moat is not going to be as wide with these higher margins. Right? So I'm right now, I think NVIDIA has gone up a lot more on AI hype and the fact that they are the first movers. But we already know of, right, Microsoft, OpenAI, they have started designing their own chips. They're like, instead of paying, the humongous amount to NVIDIA, why not build on our own? So over a long time, I do see that they will be pressurized on the business. But one thing which we talked about when we looked at NVIDIA and AI stuff is, for whatever reason, they're able to figure out venturing into a new business once the existing one starts to cool off. right? From a gaming, they moved to crypto. From a gaming, they moved to data analysis, right? Graphics. Then their chips were started to use for a lot of data analysis, machine learning and all that stuff. Then they moved to crypto, and then they moved to AI. If something else come up, which I can't even think right now, and if NVIDIA be able to pivot in that direction, great. Just on AI, I think there's going to be a lot more competition coming in. Did you see Coupang stock performance? We can see the stock performance now. So one thing is then when I'm looking at company from analysis perspective, it has nothing to do with the stock. I was doing a business analysis, not the stock analysis. Right? Yeah, Coupang has been, I think, has gone multiple places. If I look at the stock, it has gone multiple places as so it IPO'd at, I think, $40. It IPO'd at 40, probably right out of the gate, hit 69 because those were the go days of IPO market. It came IPO, yeah, in March, April 2021. Right? And then as the rest of the high growth, non-profitable companies sold off because the interest rates start to increase, we see the same with Coupang. So from $40 IPO to now almost half of it. So it only lost 50%, which I know of many companies that have lost 90% of their IPO values. But again, this is not a decision-making factor for my analysis. So nowhere, I think in my analysis, I actually had any item related to how the stock is doing. Right? We want to focus on how the business is doing. Then we'll see if I want to own the business. Then we'll find out, okay, what price do I want to own the business? Coupang is not yet profitable. This is causing investors to question whether they'll ever be able to generate sustainable profits. They are not profitable yet. So let's look at the latest. Sorry, I missed out the latest earnings results, right? So let's look at their Q3 results and see where they are. And I'll be okay with them being not profitable yet, as long as we see the path to profitability, which I guess we saw losses coming down. So let's look at their recent one, August. Q2 2023. Net revenues were up 5.8 billion, 16% year on year, and 21% FX neutral basis, right? So this is the foreign exchange risk, which is 5% foreign exchange risk on the revenue. At FX neutral, they would have been up 21%. But now it is 16% because of foreign exchange risk. Okay, they also had an accounting charge for their FLC revenue, which is fulfillment. Okay, so that's probably a one-time accounting charge. Otherwise, it would have been almost 3% even higher. So from an operational perspective, consider revenue is up, let's say 19%. Gross profit increased 32%, right? Gross profit margin was 26%. So this is what you term as your, operating leverage. You're increasing your margins at a higher rate than you're increasing your revenue, which is the direction where I want them to go. So increase 32%, whereas the revenue increased only 16% to net income. So they are actually profitable, probably barely profitable. I mean, $145 million, 2.5% profit margin. So they are actually profitable. It's not even like adjusted profitable, not EBITDA profitable. They are actually net income. EBITDA, adjusted EBITDA was 300 million, right? So, but they're even net profitable. Again, at the end of the day, this number, net income profitability, is an accounting number. And there are ways in which, if If a CEO wants net income to be positive, CFO will figure out a way to do it. Right? So I'm generally more focused on your operating income rather than the net income. And if I see the gross profit margin is up 32%, or let's go and look at their operating income. Let me bring that up. There's so looking at Q2 income, this was right. They make $147 million of operating income. That is better. It means they are able to generate income out of their operations and not, not through, let's say, higher level of depreciation and all that stuff. EPS was 8 cents. Operating cash flow for trailing 12 months is 2 billion. And they now even have a free cash flow for trailing 12 months. So not only that they are in green, again, this is one quarter. Let's look back and see how about the other quarters. This is their operating income. Let's go at their net income and see. So they have been profitable for past 4 quarters. So they were not, because they were all investing, but now past 4 quarters, they have been actually net profitable, GAAP profitable. So I don't have any concerns. Active customers continue to increase. Now they have almost 20 million active customers, and stock dilution, just 1% year over year. So that's not bad. So management commentary was they have a 4th consecutive quarter of GAAP profitability. This is great. I didn't expect them to be GAAP profitable so soon, but I'll take it. They're focused on growing profitability and increasing cash flow. I think this is a statement which I would want to hear from every CEO, is increasing the cash flow. They also expanded to Taiwan. So apart from Korea, now they are in Taiwan as well as in Japan. Right? But the expansion into Taiwan, if you go back and listen to the call, CEO was pretty bullish about how the stuff has been going in Taiwan. They see a very good traction in Coupang Eats, and they're considering fulfillment. FLC is going to be the next growth driver. Remember, optionable. Right? So this is new option for them. So we're all good. So that's on investment process. Any questions before we jump on to the last topic? And we'll have to hurry in this last topic. We're already late. But I hope you won't mind staying over for, let's say, 15, 20 minutes. Or if you have a question, maybe we will skip the earnings. I'll do it next week. 20 minutes over, okay? Or skip it? Tell me. I see, okay. I got 2 okays. Go for it. All right. You're all like, oh, come on. Let's do it. Okay. All right, let's move on. So earnings. We got 4 earnings to look at. ASML. Let's start with the ASML. But before I jump into earnings, this week, there was another news around Canon. So those who don't know about ASML, ASML is the most important company in the world that you don't know of. There are 2 most important companies, both we're going to talk about today. Right? ASML is the bestest or mostest of that most important company in the world. So this company makes the machines that are needed for producing the high-end chips that are used in your cell phones, that are used in your not in automobiles, but mostly in your cell phones and other devices. And those chips are, let's say, less than 7 nanometer, 5 nanometer, and now we are talking about 3 and 2 nanometer chips. Right? So these are the size of the chips. You can put in more and more transistors into the chips, make them more powerful without really increasing the size of the chips. So ASML makes machines that help the foundries, the companies that create those chips, to create those high-end chips. So we're going to talk about two companies today, which are in the similar industry, semiconductor industry, TSM, Taiwan Semiconductor Manufacturing, TSM, which is a company that creates the chips. NVIDIA doesn't create their own chips. Apple doesn't create their own chips. They design the chips and outsource the development of the chips to TSMC or to Samsung or to global foundries, right? And when TSM is developing the chips, they need a machines to develop those high-end chips. That machine, which is a extreme EUV machines, extreme ultraviolet lithography machines, is created by ASML. And ASML is the only company in the world that actually create that machine. It's not that they are the best in creating the machine. There is no other company that actually create that machine. And if you're not talking about the chips that you need for your latest iPhone gadgets, or for any other purpose, those powerful chips, you're looking at 5 nanometer chip, 3 nanometer chips, you need those EUV machines. And there's no one else in the world that does it. So that's why it is the most important company in the world, along with the TSMC. If these two companies don't exist, everything will stop, because right now everything is dependent on chips. That's I like to say, it's the most important company in the world that you never heard of, right? So this week, I saw news around Canon came up with a new tech that would give me a little pause, saying, is this a major threat to ASML, right? So overall, I don't think we have time to go through all this, but overall, I don't think that I'll be worried about the ASML's competitive positioning right now, because the Canon, so they came up with a new nano imprint manufacturing system. So instead of ASML's, creating the wafers using the laser lights, what they are doing is kind of a stamping process. Again, I'm not going to go into the details, but it's an unproven one. Canon says that they have tested it, and again, now they have to productionize it. Customers will have to have a faith and start to buy it. I would say at least 5-10 years away. So I don't think it's a major threat right now. So let's look at ASML numbers. So there, from a numbers were, the revenue was $7 billion. Guidance is between 6.5 to 7 billion. EPS is $4.83. Revenue, little bit of miss on expectation. EPS was a little bit of a miss. That's okay. They also announced a dividend of 1.45 euro per ordinary share. So this company provides dividend. They also do share buyback. And I would say growing nicely on a revenue. Now, when it comes to the semiconductor, at least my understanding, I'm not from a semiconductor industry. I know Sajjan is, probably can teach a lot more details around this, but it's more of a cyclical industry, right? It used to be a lot more cyclical. I think it's become a little less, but it is still a cyclical industry. You want chips? You're not gonna, turn around and can put up a fab plan to create a chip tomorrow, right? Start thinking about it 10 years earlier. So we have seen phases wherein, there's a need for semiconductor, a lot of fabrication plants will be set in. Now, then we see a glut of that, and then we see, the overall demand goes down because everyone has hoarded it. Now I don't need it for next year. And we saw the similar pattern. When the COVID hit, everything was shut down. Everyone was scrambling for chips. They ordered a lot more chips. Now we see, we already pre-ordered so many chips. We see a little bit of a slowdown because a lot of inventory was there with the customer. I heard the same thing, ASML CEO talking about it. We heard the same. I'm going to look at a TSMC. They had a similar stuff. Hey, customer is still working with his inventory and all that stuff. So 2023 has not been, that great because everyone had stocked up on whatever they needed in 2021 and 2022. Remember one of the earnings where we reviewed ASML, customers basically asked them to ship them the machines even before testing. They said, no, we need the machines at our place. You come and test it at our place, right? So much was everyone wanted the stuff. So now we have that glut. So right now it's in a downturn and there's a high level of uncertainty around what the demand will look like. I really think the management of ASML is a lot more conservative. So maybe a little bit of a sandbagging there. But again, the question is, there's a lot of inventory still there with the customer. They don't expect 2024 to be a same growth as of 2023, right? It probably, so don't expect too much of a growth in 2024, but 2025, they're expecting a significant growth again. So they're saying, management said that 2024 is going to be a more of a transition year, right? And so we saw that the net booking means later on they will convert to revenue, which gives an indication of how the revenue will look like in future. Booking was actually down. And that's what gives us a little bit insight into, hey, in the future, the revenue will be not, as strong as you might be thinking. So again, what else? Yeah, so overall, and after that, I think we saw ASML shares were down because, hey, 2024, not you're going to grow at the same pace as 2023, and we don't see any additional growth in 2024. I don't like it. From my perspective, I think I still want to hold the ASML shares. I don't see any change in the thesis on their operations. Only thing I need to watch is this Canon new tech from the Canon. Is it gonna become, when is it going to be becoming challenging for ASML? Probably I'll have to talk to someone who works in a semiconductor industry. So that's on ASML. I'll be happy shareholder and I'll continue to hold. Next important company is TSM, which is Taiwan Semiconductor Manufacturing Company. This is a fab company, means they make chips. Their third quarter revenue decreased. See, downturn in 2023. Compared to second quarter, which is a consecutive one, third quarter is up. But you generally compare year over year. So year over year, it was a 10.8% of decrease. For TSMC, this was a third consecutive quarter with year over year declining revenue. So 2023 hasn't been great when it comes to semis, because everyone had hoarded up during the COVID. Like during COVID, all of us went and got, 5 cases of water bottles, and probably, some of them still are sitting in the garage, and we didn't have to go and buy it for next 8 months. Same is the case with semiconductor. Okay. Results was the expectation. They beat the revenue estimate by 3.6%. So the revenue came at 7.82 billion, which was a little more than what the expectations were. And they also not only beat it, they also beat the guidance. Right? So let's look at the numbers. Revenue was 7.28 billion, which was, of course, decreased year over year. We talked about it. Gross margin is 54%, which is great. Operating margin 41%. It means they are actually not spending too much on R&D. Like 40% operating margin for the semiconductor industry is great. Net profit margin is close to 40%. I love that. Breakup: 3 nanometer accounted 6%, 5 nanometer accounted 37%, 7 is 16%. So advanced tech, which is defined as 7 nanometer and more, accounted 60% of total wafer revenue. This is 60% of TSMC revenue. If my last I read was TSMC actually does 80 to 90% of the world's advanced chips is created by TSMC. 80 to 90%. And that is why this is, again, one of the most important companies that you may not have heard of. Coming to the guidance. So their guidance was for the next quarter is going to be between 18.8, which was higher than market expectations. Spending will be $32 billion for whole of 2023. I think earlier they had mentioned, or the market was expecting around $30 billion. So they're going to do a lot more CapEx. It means for the future growth and to gross profit margin, that's fine. So stock was up 5% because they raised the guidance and then they raised the revenue for the next quarter. So now what they also mentioned was that 2024, the market will start to recover from them. Now that got me thinking, saying ASML was saying 2024 is going to be more of no growth, whereas TSMC is saying that the worst could soon be over for the chip industry, because 2023 hasn't been that great, and the demand could recover going into 2024. Either their timelines, because ASML will have, if TSMC have to meet demands in 2024, they probably have their machines all set up by 2022. That's the only way I was able to reconcile the fact that ASML says that the demand may be a little tepid in 2024, whereas TSMC says they see that demand is going to grow. I'll be very happy if ASML is wrong in their analysis and they see, or I guess probably they may be sandbagging because they're generally very conservative. But in any case, market liked what they saw from TSMC. Stock was up 5%. And then in a sympathy, even ASML was up 4% or 5%, whatever. So that's on these two chip-related companies. Any questions? Next 10 minutes, 2 more companies, then we'll be done. Any owners of these TSMC and ASML? No one owns it? Come on, I know a few of you do own it. All right, let's move. Big time. All right. Let's move on to the very ASML is good for long term. For me, yes, it is good for me. But I don't know about your personal situation, so I don't know if it is good for you or not. Tesla. Our main objectives remain okay, so let me look at Tesla's numbers. By the way, I mean, those who joined a little late, I joined the Tesla club. I eventually did my starting position in Tesla this week. And if I look at, probably this is the least loved management of which I own a stock. And I actually dialed into Tesla's earnings call. After lunch, I went out for a walk. I dialed into Tesla's earning call, and in the Q&A section, after like 10-15 minutes, I was so pissed off, like, I'm done with it. I'm not listening to it. I mean, they have zero respect for questions. And it was more like they were a little bit being condescending to the questions and laughing about it. And Elon was like, I don't want to answer this. And someone asked, I will get into the results, but someone asked, I think one of the investors, they asked about the question around, when do you think that the Optimus could be used in your factory plants, right? In a gigafactory, etc. So Elon says, I don't want to share that information yet. And then he said, but he can do yoga. Optimus can do yoga. probably some salsa as well, salsa dance. And then the rest of the gang started laughing on. I'm like, and this didn't happen on the first time. I'm like, what the heck? So this is the most, again, this is just me, as you might be loving, but this for me, this is it's the most unloved stock, unloved management whose stock I've just initiated a position. It's a starter position, may want to continue or may not, that only time will tell. But anyway, some fun. All right, so revenue was up 23 billion. Revenue was 23.3 billion, up 9% year over year. Operating income 1.8 billion. So this is the stuff that everyone needs to pay attention to. Is their operating margin is down 964 basis points, almost 10%. Now it is operating margin is 7.6%. Right. So the whole till now, all the why Tesla is considered to be a great stock or why they commanded such a high valuation was that as compared to the other auto industry or companies like GM, Ford, Stellantis, or even outside of US, Tesla's margins were really high. Tesla's margins were like 17%, 18%. Whereas the Ford and the GM operate at a margins of, I don't know what the real number is, but probably 7%, right? And that was one reason why Tesla was highly valued. That hey, it's not a car company. But this quarter we saw its margin coming down to 7.6%, and shouldn't be surprised to anyone because of the price cuts that they've done for the cars. Model Y is now down 30%, is 30% cheaper. So then at the start of a year. So Tesla has been cutting prices for their cars. Now there are two thoughts to it. One is the bulls will say Tesla just want to kill all the competitors. And the reality is if I can get Model Y in 30,000, why would I go and buy a car from GM or a Ford or let's say Toyota? If at the same price point, I can get Model Y. If the Model Y was 50K, yeah, then the 20K is a big factor in my decision making. So Bull says Tesla want to kill all the competition, and they will be able to operate at such a low margin, right? Even after bringing down the cost by 30%, still they're able to generate 7.6% margin, right? But then it means your valuation also need to come down. So that's why we saw Tesla also stock is now what, 220, 215. It used to be close to near 300. Even it was close to 400 last year. So free cash flow, 848 million, even with this low margin, they were still able to generate free cash flow. And cash and equivalents, which is very positive, is $26 billion. Now, even if Elon Musk doesn't do anything with this and just put it in a treasuries, he's going to make up what, close to billion, 1.25 billion, but for just doing nothing. There's a free cash coming onto the balance sheet for doing nothing, but just waiting and enjoying the return on a risk-free rate of return on $26 billion. Right? So the factors that impacted the margins negatively reduced ASP, which is the average selling price. No surprises here. Increase in operating expenses driven by Cybertruck, AI, and other R&D projects. So when it comes to Cybertruck, it's anticipated to launch somewhere. They mentioned that it'll start to get delivery in November. We don't know when in November. I don't remember the exact date, but their expectation is that they'll start to deliver it in November. Whether it'll be successful or not, God only knows. The other thing which they mentioned and which also impacted the stock price was he was trying to set expectations saying don't Cybertruck won't be a money maker for quite some time. So they're not going to make tons of money with Cybertruck to start with. Third thing is cost of production ramp, and there were factory upgrades happened, so there was a cost to it, and then you could create those many cars. And then finally is negative foreign exchange impact, because they do sell in China as well. So that if you have a good amount of revenue coming out from non-US currency, so you'll be impacted by foreign exchange. Positive things is a lower cost per vehicle and higher credit benefit. Now your cost of vehicle is coming down, so the customers can get that benefit. Growth in energy generation and storage as storage as a service. So Tesla has got multiple businesses. That's what Bull says. Cars is what we know. They have an energy storage business. They have now that Optimus will be coming on to from the robotics business. And then eventually some part of a time, we will see their robo-taxis on the road. Right? So what else to do? Yeah, so if you see this red, which is where they're ever since start of this year, the operating margins have been coming down because they've been cutting prices of the car, which impacts their margins. So some highlights from a conference call. If you're really interested in going all, I will post this link here. If you're interested, I only picked up a few which caught my attention. So number one, Elon says because people can't afford Tesla because of high interest rate, right? Come on, yeah. Everything today, you can blame everything on high interest rates, right? I'm surprised he didn't talk about Ozempic here. People don't want Tesla because Tesla sales are impacted by Ozempic. Every other company is talking about Ozempic now. In any case, he says it's because of the high interest rate. How I can't emphasize, that the vast majority of people buying a car is about a monthly payment, right? So as the interest rate increases, monthly payment increases. So he says that's impacting. People can't afford Tesla because of that. You can't grow at 50% CAGR forever, which is true. He tempers the expectations on the Cybertruck, something that we already talked about. I just want to temper expectations. It's a great product, but financially it will take, I don't know, a year, 18 months before it becomes a significant positive cash flow contributor, right? So it's not going to add to the cash flow to just at the start, right? So don't raise your expectation that Cybertruck is going to get launched and we should see a significant positive contribution incremental coming from Cybertruck. That's not going to happen. Probably need a lot more investment than what it may be able to bring out. That's on Tesla. And quickly, we just hit 20 minutes mark. Netflix. So Netflix, they turned the corner of on their subscriptions, also on their subscribers. The major concerns that the Netflix shareholders had was the decrease in the subscribers that we saw in the last, I think 2 or 3 quarters ago, and stock just sold off. Now it looks like they turned the corner around on the subscribers. 8.8 million people added, they added 8.8 million, which was almost 2 million more than what Street was expecting. So that was like a boom, completely. They blew it, out of the park, and then the markets loved it. So other thing to note is their ad plans. So Netflix has been pushing more and more people towards their ads because they realize that their ad subscription tier is way more profitable for them than the non-ad, the original tier, right? And so that's now paying off because the ad membership is up 70% quarter over quarter. And 30% of the signups are on average happening to the ads plan. And to push more people towards ad, they're going to increase the price of the non-ad plan. So, which I feel like, come on, Netflix, they changed themselves, right? When they started, it was all about no ads, uninterrupted, watch whatever you want to watch, right? No ads, no interruptions, just enjoy whatever show you want to see, right? Now they're moving on to ad supported stuff. So, but this thing means that if they can confident, and this is not the first price increase they have done. They've increased the pricing earlier also. And if they think they can continue to increase the price without having an impact on the revenue, that does demonstrate some pricing power, which is what their mode is. Other thing to notice is giving more and more international. And that's the reason why they need to have more ad side is international users can't afford the pricing that US customers can. So Netflix has to figure out other sources of making revenue. And one of the sources is earning through ads. So now I see why they have focused on more on the ad side. Right. From a cash flow perspective, they expect to have 6.5 billion in free cash flow, which is higher than the previous forecast. So not only they beat the revenue this year, they also beat their cash flow forecast. And they also increase their buyback to $10 billion. So I don't know why they're buying back, because making content is expensive. So they could have utilized this $10 billion to basically invest in the business and make more content. But as a shareholder, I'm not a shareholder. I don't own Netflix. Okay, so, but I guess shareholders will rejoice that they are buying it back. Forecast side, not much. I think nothing specifically that stood out, but market liked the fact that their subscriptions are back again. So revenue grew 7.8%, operating margin 22%. More importantly is this year-over-year growth on streaming paid memberships. So overall net additions of 8.76 million was pleasantly surprised for the investors, and the stock was up 14-15%. So if you are owner of Netflix, congratulations. I don't own Netflix though. All right, that brings us to the end of section. Sorry it took a bit longer, but I appreciate you spending time, almost 2.5 hours. And I value your time. So my intent is to, make sure we can bring things that is useful for you. So if you want me to pick up on specific topic, do let me know. You can always email me on, let me share my email address. Or come and talk here, chat here. All right, guys, I'll let you go. I'm hungry. Let's see what I need to cook today. All right, if no questions, thank you. Have a great week, and I'll see you next week. All righty. Bye-bye. Right. Welcome, Narendra. Welcome, Puneet. Good to see you guys here today. I hope you liked it and probably will join again. Cool.